David, welcome to our Vistage webinar.
Thank you, Stephanie, and welcome everyone.
It's great to have you here. So let me know, David is going to share a presentation with us all, and then we will have time at the end for Q&A. So please feel free to put your questions into the Q&A, and I'll be able to check in and make sure we can get to as many questions as we can at the end. So over to you, David.
Thank you. So growth, inflation, productivity, interest rates, tariffs, employment. I've got quite a long list, and they're all topics that have been in the headlines lately and things I think that are worthy of us talking about today. I'll go through most of those and a bit more today with a focus on what's happening right now in the Australian economy and the outlook for the year ahead. But I'm also touching on some other major economies around the world. Now, I've got quite a lot of charts, which will hopefully help with our insights. And I'm more than happy, as Stephanie said, to have a discussion and answer questions at the end of this. Now, before I get into the presentation more, I should tell you that before I give any forecasts in particular, I always like to start with one of my favorite lines about economists, which is, if you put all the economists in the world in a line, they still won't reach a conclusion. Having said that, I think I can be fairly certain in predicting that this afternoon the RBA will be on hold and won't make any changes to interest rates. And then later this week in the US, the Fed's meeting, and I think we can be pretty much 100% sure that they will cut interest rates again by a quarter of a percent. We'll get on to talking about this and more a bit later. One of the first things I wanted to talk about is productivity and why it's important. And as I started to mention, we will probably remember the government had a productivity summit earlier this year. A lot of talk, but I haven't seen much happen there. A lot of promise and no action, basically. Why is this important? Well, it really is holding us back as an economy. And one of the comments I put on this slide there really stuck in my mind at the time of the government summit, which was someone had pointed out in the Financial Review that if you want to open a cafe in Brisbane, there are 31 steps you have to go through before you're allowed to sell a coffee, which is just crazy. I've seen other examples. Another one I saw recently was that if you were a railway worker in Wodonga, which you might know is on the Victoria-New South Wales border, you have to wear a high-vis vest, which makes sense, so the trains can see you, and it has to have stripes on them. But if you walk a few hundred metres and cross into New South Wales, you have to have a high-vis vest with a cross on it. So again, a lot of issues, perhaps because of our states, but a lot of these things just making it awfully difficult for business to get on with their job. And as I've mentioned on this screen, and you'll see in the chart, productivity and regulation and so on were quite a big issue that were raised by Vistage members in our latest survey in terms of risks to the outlook. Almost a quarter of members mentioned that as one of the big problems they saw in holding things back and providing risks. So why does productivity matter? As I've put there, it's a very simple equation. Growth only comes from two things, more people or more productivity. It's really as simple as that. And you can see there a quote from our treasurer who has said it is the best way to sustain and grow living standards, make the economy more productive. Whether they're doing something about it or not is something we've just touched on, and really that's the key. So in Australia, population growth previously was probably growing around 2%. It's probably more like 1.5% these days. A lot of that coming from immigration. Like most developed countries, the birth rate in Australia has been falling for decades and is probably not going to pick up soon. So population growth is probably going to be less of a driver maybe than it was 20, 30 years ago in terms of growth of the overall economy. Productivity has been growing, or hasn't been growing. In fact, for quite a few years now, it's been hovering around zero. So the economy has almost been growing just in line with the number of people we have. We did see a spike in the September quarter GDP numbers where productivity jumped up by 0.7%, but I'm not convinced that's a trend. I suspect there might have been something one-off going on there. So if we're talking about population growth of 1.5% and hopefully a little bit of productivity growth, if we can get our act together, we're not going to see the economy growing much more than 2% in the medium to longer term, which is well below the sort of 3-4% we might have been used to historically in Australia. And in fact, recently the Reserve Bank has suggested that 2% might well be the limit to growth before we start to see inflationary pressures kick in, which of course means if it gets above that level, we might see them looking at putting rates up again. But we'll talk about that a little bit more later on. So how has growth been going? I'm sure you're aware it has been pretty slow. Last 2 quarters, it has picked up. You can see from the orange line there, which shows our annual growth rate. And it's been 2%, 2.1% last 2 quarters. So getting towards that sort of speed limit that I've talked about there. And in fact, in recent quarters, the domestic economy has been growing more than 2%. The difference is growth overall was held back by a fall in inventories and also negative impact from net exports. So growth in import and a bit of a fall in exports. This chart shows you quarterly growth, and we've definitely rebounded from the slump that was sort of end of 2023, early 2024. It's still been patchy though at best. You can see there, growth's hovered around 0.25%, 0.4 in the recent quarter, which was a good one, but down still from 0.7 the quarter before. So we're not going up in a straight line, even though things seem to have picked up a little bit. The positives in the recent quarter were that consumption and private investment have started to take over from the government as drivers of growth. And that's certainly something we want to see to keep things going in the longer term. Similarly, members in our recent survey also suggesting that maybe there's been a little bit of improvement in growth that they're seeing. You can see on the left of this chart, the September survey saw a little bit of a pickup from previous ones, but still overall, most people think the economy is worse than it was a year ago, or at best has stayed the same. So the pickup that I'm talking about at the macro level maybe hasn't quite flowed through to all businesses yet. Interesting though, although we seem to be pessimists about the overall economy, in terms of our own businesses, we got some quite positive feedback in the survey. So that was the economy as a whole. What about the individual states? We can see here, this is the latest quarterly growth at the state level, with New South Wales, Victoria and Queensland all doing quite well, but still 1.5% type growth levels. Tasmania, I haven't quite been able to figure out what happened in that number there, but apparently there was a big fall in government capital expenditure, which explains that very negative number there. Now, the overall economy grew at 2%. And as you can see here, none of the states grew at that level. How can that be the case? Quite simply because state numbers don't include exports. So although the overall economy has been boosted by our exports, that doesn't show up in the state numbers. The other way of looking at how the economy is going is at an individual level, per capita growth. So economic growth per person. It's been hovering around 0, as you'll see here, for the last couple of years. What does that mean? Well, it means that the economy as a whole is growing modestly, but growing. But at an individual level, we've basically gone nowhere for a couple of years. So the growth we've seen has been achieved by population growth, but that more people are sharing the same or slightly bigger pie. So for each of us, we're not really getting anything more than we were before. Let's look at inflation, unemployment, and some of the other things going on in our economy. Now, inflation seemed to be going well earlier this year, late last year, and had got towards the bottom of the 2 to 3% band that the RBA looks for. So that was certainly good news. Lots of people were talking about rate cuts. I think as recently as 6 months ago, people were talking about 2 to 3 rate cuts in the next year. And then where that star is on the chart, we had that shocking number recently when they started the new monthly CPI series, where headline inflation was at 3.8%. And even the trimmed mean, which takes out some of the volatile things, came in at 3.3%. So still well above that 2 to 3% that the RBA aims for. The Treasurer said inflation doesn't go down in a straight line, which might well be true, but I think the trend here is a worrying one. It seems to have picked up again. And it's also picked up across many sectors. Previously, we'd seen things like energy, some government charges. Now it seems that most sectors are seeing inflation creep back in again. The other thing the RBA considers, and when it's looking at rates, is unemployment. Unemployment has gone up a little bit, so we were under 4% and we're just over 4% now. 4.3 was the latest number, but it's at a very low level historically, and all the indicators are that the employment market is very tight. Vacancies are at high levels, people can't find staff. The latest number showed that hours worked have picked up, so the people that are in work are working longer hours. And this also is reflected by the Vistage members in our survey, who mostly said they were going to increase employment in the next 12 months. Around half of members have continued to say that they're so happy with the outlook for their own business, they're definitely looking to increase staff. However, many of them listing lack of available experienced staff as one of the issues they're facing. Let's have a look at individual consumers and businesses in Australia. So this chart shows you consumer sentiment. This comes from a combination of surveys done by ANZ and Westpac and the Melbourne Institute. Looks great. If you look at that blue line the last year or two, it's picked up quite strongly, but you can see there, if you go back 10, 15 years, it was around the 100, 105 level. 100 is the long-term average. We're picked up now to be less than 90. So although consumers are a little bit more confident, still not really confident overall compared to historical levels. And that's despite having 3 rate cuts in the last year or so. Similarly, at the business level, this is a NAB business survey. They ask people, how do you find current conditions? How confident are you of the outlook? And again, all of them are sort of hovering around that 0 level, where half of them are confident, half of them are not. And another indicator, I think, that's suggesting that the outlook ahead is probably fairly subdued. One good thing we've seen is a pickup investment. And as I mentioned, that was one of the drivers of growth in the recent quarter in Australia. A lot of that apparently coming from huge investment in data centres. But we've also seen a pickup in things like machinery, equipment. So businesses seem to be investing money, and that would suggest some confidence in the outlook, even though those overall numbers are still not really suggesting that people are ready to spend up big time, either at the consumer or the business level. Again, a similar story from our own members in the survey. Most people fairly confident that they'll be looking to increase investment in the year ahead. Not as many as we were seeing 6 to 9 months ago, but still definitely a fairly positive outlook there. Now let's talk about the Aussie dollar. It's a rather messy chart. Apologies for that, but I'm trying to put all the currencies on one chart here. And what does it show? It really shows that the Aussie dollar's gone fairly much sideways for the last 4 or 5 years. Depends which currency you pick, obviously. We're a little bit weaker than we were against the US dollar since the end of the pandemic. We're much stronger against the Japanese yen. That's really the only currency we've actually appreciated against. And a lot of this has been driven by China, and I'll talk about China's growth and their outlook in a little while. But the fact that China is growing much slower than it has in the past is certainly one of the things putting pressure on the Aussie dollar. And there's not really much suggesting that that's going to change. If, as some people are suggesting, we get rate hikes next year, which I'll explain later, I do not think is likely, that would certainly obviously add some support for the Aussie dollar. And just generally, the Aussie dollar is often seen as a play on global growth and risk. And, if people are happy with the world, they're willing to take risk and growth's picking up, the Aussie dollar usually does well. As I mentioned, that's probably not the case at the moment. We're talking about sort of modest growth globally. We've got issues in Ukraine, in the Middle East, uncertainty over Trump and his tariffs. All of these sort of things are probably going to continue to keep a bit of a ceiling on the Aussie dollar, I think. One of the other main drivers is the iron ore price, and this has often been something that's been fairly well correlated with the Aussie dollar, particularly against the US. And the iron ore price, again, has pretty much gone sideways to slightly down for the last few years. That obviously is because of China and their slower growth. They are by far the biggest buyer of ours and all the iron ore globally. And unless we see a lot more, particularly infrastructure and construction spending in China, we're not likely to see a significant pickup in the price there. So let's talk about interest rates. I'll talk a bit about the Reserve Bank and what they focus on, and obviously then we can move on and talk about where I might think things are going from here. So this is a graph of the Reserve Bank's cash rate, the one that we hear about in the press every month or so when they have their meetings, and there's one at 2:30 this afternoon where, as I mentioned, I don't think we'll see any action from them. You can see there in 2020, post-pandemic or in the middle of the pandemic, we basically had zero rates, and that stayed that way for a while. We've had a big jump up to over 4%, and we've now seen cash rate come down from 4.35 to the current 3.6. And we've had 3 rate cuts this year, February, May, and August. But still, it's quite low historically. If you look back there, late 90s, early 2000s, through until the financial crisis, 2008, 5-6% or more was not an uncommon cash rate for the Reserve Bank in Australia. And I'm sure if you look at the start of that chart, if you're old enough like me, you'll probably remember in the 90s paying 16-17% or so on your mortgage. So I don't think rates are particularly restrictive in Australia at the moment, which would therefore suggest there's probably not much room for them to come any lower. I would warn you though, I mean, I'm going to give my predictions, but as I've mentioned earlier, maybe take all predictions with a grain of salt. And I noticed, I think it was around June, that the market was predicting 105% chance that the Reserve Bank would cut rates at that meeting, and they didn't. And markets are now pricing in an 85% chance that there'll be a rate hike next year. Again, I'm not convinced that that's going to be the case, but the markets and predictions seem to swing around week to week, depending on what data comes out. So I think we have to be a little bit cautious in jumping at the headlines and the talking heads on television telling us where things are going. So where do I think things are going, or where do they think things are going? First of all, it's worth pointing out that when the Reserve Bank does their forecasts for the economy, they use the market forecast. So last time, as you'll see here, that was talking about one more rate cut. They've warned there, though, that underlying inflation is expected to stay above 3% for quite some time, and that's one of their key targets. And in fact, if they don't cut rates, they're saying staff have said then that perhaps inflation will come closer to their target. So another suggestion that maybe we're not going to be seeing rate cuts from here. And it's important to point out they focus only on two things: inflation and unemployment. They don't target house prices. They don't target the Aussie dollar. So they're the two things we really have to look at. Unemployment's picked up very modestly, as I mentioned earlier, but it's still at very low levels. That inflation at 3+% is obviously a worry for them. But I think what we have to look at in the months ahead is whether there's some one-off forces there and whether inflation might well come back within the range. I think it's possible we could get one more cut in 2026. I certainly don't think we're looking at rate hikes in the near future. If I was a betting man, I'd probably say it's maybe 60% there'll be no change, 40% we might get one more cut, but it's a very close call. We've seen similar things in other major economies where market expectations were for more cuts in the year ahead, as things seem to have slowed down a little bit. But again, we've seen a pickup in inflation in many other markets, and the rate cuts globally maybe are less likely than we were looking at 6 months or so ago. And unusually, maybe the Bank of Japan is the one that stands out, where they've been putting rates up because of inflation and are likely to keep putting rates up. The one with the most likelihood of further cuts is the US. I mentioned at the start, the Federal Reserve Bank in the US meets, I think it's Wednesday, Thursday this week, and is likely to put through another 0.25% rate cut. President Trump has been pushing them for huge cuts in interest rates. He thinks interest rates in the US should be 1% or lower. But members of the Federal Reserve, those that vote on interest rates, are concerned that inflation's a bit stubborn and might well stay above their target, which is 2%. So, as I mentioned, 3 rate cuts here this year. Has that helped? In our latest survey, not that many people suggested that it's had a big impact on their business yet. We did see some sectors suggesting they've seen some positive impact, particularly people working in businesses focused on things like construction, housing, those sorts of areas. We've seen that modest pickup in consumer sentiment, but probably the rate cuts we've seen haven't flowed through quite as much as we might have expected. I'll touch a little bit on exports and also the budget position in Australia before I talk a little bit about some of the other major economies globally. It might not surprise you to see here that the different scales on this left and right of this chart, but our resources exports are worth probably 4 times anything else, the rural exports, services, etc. What I think people don't probably realise is that services is now a bigger export than rural products for Australia. We're not riding on the sheep's back anymore, but on the back of tourists and students. So tourists coming to Australia, overseas students studying here are counted as exports. And if we go overseas on a holiday, that's counted as an import because basically we're spending money outside of the country. And where do these exports go? That's obviously a key thing in terms of outlook for growth. China. China is now the destination for around 1/3 of our exports. If we add in Japan and South Korea, those 3 countries are over half of our exports. US, you can just see there, the pale blue line has been going down for the last 20 years and is really not a significant destination. So despite all the talk about Trump's tariffs and trade policies in the US and so on, it's not a major export destination for Australia. It might well have an impact, in terms of world growth, and particularly if he puts the threatened huge tariffs on places like China and slows down their economy, that would flow through to us. But in terms of our own exports to the US, it is not really such a significant thing. And the other thing that's probably interesting that people might not realize is that Australia is one of the few countries in the world that actually has a trade surplus with China and a trade deficit with the US. So despite what you see in the shops made in China everywhere, we actually export more to them than we buy from them. The budget and the government position worth commenting on briefly, I think. You will see here most of the green lines on this chart are in the negative territory. Government budget, federal government has been in deficit for most of the last few decades, and the predictions you'll see there from the Treasury are for that to continue to be the case. There are no plans for significant improvement. And states are in a worse position. State budget deficits are bad and getting worse in most cases, and the debt is also an issue, as you've probably read about, particularly for some states, such as Victoria. So should we worry about these budget deficits and government debt and so on? Generally, yes, but I thought it's interesting to show you this chart. You can see there I've put a circle around Australia. Compared to almost all major economies, Australian government debt as a percentage of the economy is actually quite low. We're down there almost the same as the Netherlands, but only a touch worse than Switzerland, which is in the best position. If you look at major countries like UK, France, Canada, they're all got government debt that's more than double our level. And the US, 124%, basically got government debt to GDP of 3 times what Australia's got. One chart on the UK before I talk a little bit about the US and China before we finish up. I mentioned how inflation had picked up here and is also picking up around the world. You will see here there's a massive improvement in the UK where inflation post-pandemic had got over 10%. It fell to 2%, but in the last 12 months has crept back up to almost 4%. So again, becoming a bit of an issue for them. Similar story in the US, but not as dramatic maybe. Trump tells us tariffs are a beautiful thing, but I suspect consumers in the US are starting to realize that might not be the case. And certainly they're one of the reasons we see that small pickup starting in inflation in the USA. We've heard that when the talk started about tariffs and trade restrictions and so on, a lot of the big businesses in the US, particularly the retailers like the Walmarts, went out and built up big inventories ahead of it. So some of the price pressures that we might see probably still haven't quite flowed through. And then where they have happened, we've seen Trump start to get a bit nervous and the government's taken back recently tariffs on coffee and bananas, 2 things that probably most Americans buy quite regularly and where the prices had gone up sharply, and 2 things that the US doesn't produce. So it never really made much sense to put tariffs on coffee in the first place when it is pretty much 100% imported. In terms of where inflation's going in the US, this is the US central bank's own expectations. So certainly they see it coming down towards that 2% target, but you'll see there it's a slow process. They don't really see it getting there for another 2 or 3 years. And we might hear a little bit more later in the week when they have the meeting, but that would suggest that Trump's hope for significant rate cuts are probably not going to happen. In terms of growth, US is doing better than a lot of the world, but still not that great. And I should highlight, this looks like a great pickup in the recent quarter or so here, but, and it's a very important but, growth was driven by a collapse in imports. which might well be related to the trade and tariffs we've been talking about. And it was also due to businesses building inventories, as I mentioned, again, trying to get in ahead of the tariffs. So business investment was actually strongly negative. Consumer spending was very weak. So that what seems like a pickup in the US may not be a trend, but was actually driven by negative factors rather than positive ones. Where's the US going? This is a table that looks a bit messy. I apologize for that, but this is put out by the Institute of Supply Management, ISM, in the US. They survey their members every month, a bit like Vistage does with members here. And I've highlighted a couple of things here that I think are really worth pointing out. The first row, manufacturing, direction, contracting, rate of change, faster. So not only are members seeing their industry slowing, but the rate of slowdown, if you like, is picking up. Prices increasing faster. So again, not only will we see inflation potentially picking up, but they're seeing it picking up faster than it was previously. And at the bottom, in bold, you'll see their overall economy growing, but growing slower, is the opinion of those surveyed for the ISM monthly survey. Consumers in the US as well, confidence has fallen in the last little while and has actually pretty much fallen steadily since the presidential election. Unemployment, this chart, it doesn't really show it because of the huge jump during the pandemic. The US didn't have the job seeker type programs that we had here in Australia, so there was a massive pickup in unemployment, which does distort the chart a little bit, but unemployment has been picking up recently. And now I mentioned how President Trump would love lower rates, and one of the things central banks look at is a pickup in unemployment. That would certainly be something that might suggest rates should go down. Mid-year, we saw a number come out that showed quite a large pickup in unemployment. The president wasn't happy with that, though, and he sacked the person in charge of putting the statistics out. And one last thing on the US, I saw this recently and it was a shock to me, and I think something that might surprise you. We talked earlier on about government budgets and debt levels and so on. The IMF here is suggesting that in the next 4 or 5 years, government debt as a percentage of the economy in the US will be worse than Greece and Italy. Now, you probably remember the Euro crisis of 10 years or so ago, where everyone thought Greece was going broke and they couldn't pay their debt back. They're now in a better position than the US. And similarly, Italy catching up. So that's probably not a chart I would have expected to see 5 or 10 years ago. And not only are US debt levels high, but the current administration seems to be hell-bent on pushing them higher by spending money and increasing the budget deficit. We've talked about global interest rates. I'll just skip that chart and talk a little bit about China. As I mentioned, over a third of our exports go to China. It's obviously key for Australia from that point of view. If you go back 20 years, we were used to China growing at 10%. It then slowed down 2010, 15, 7-8% growth a year from China was quite normal. We're now seeing growth rates in China of something around the 4 to 5%. And that growth of the 8s and the 10s previously was driven a lot by infrastructure. They built freeways, railways, high-speed trains, a lot of construction of apartments and so on, and great for Australian commodity exports. They need lots of iron ore, coking coal to make the steel and so on. That's not really the case now. And as I said, that's probably a big drag potentially on the outlook for Australia in the future. Why has it slowed? Well, partly perhaps the infrastructure and construction side of things, they've probably got a bit ahead of themselves. The other thing is here population. Now, you might remember at the start, I talked about how growth is driven by population and productivity. Population growth in China has now turned slightly negative. And that's obviously one thing that's not going to see the economy growing much if they don't have more people, and particularly the aging of the population in China means that the workforce is shrinking even more than the overall population level. Now, on a lighter note, the government is trying to do something about encouraging population growth. And I saw an article in the Financial Review earlier this week which suggested the government is making tax changes to try and encourage people to have more children. They are adding VAT, like our GST, on condoms and birth control pills, and taking tax off childcare and marriage services. Probably not something you would have expected in an economics presentation, and I wish them luck with that, but I'm not suspecting those small changes are going to make a lot of difference to population growth. So where's China going southern in terms of growth? 4 different indicators here on the one chart, which is a little bit messy, but the top one in red is the one perhaps worth highlighting. Similarly to that US ISM indicator we talked about, this is the Purchasing Managers Index in China. And you can see it's hovering at or below that 50 level. Now, a level above 50 suggests manufacturing is growing. Below 50, manufacturing is slowing. So not much sign of a pickup from the manufacturing sector there. There was a lot of talk about China moving to more of a consumer-driven economy as they slow down the infrastructure, construction spend, etc. If you look at the bottom slide there on retail sales, not a lot of sign of a pickup in that side of things either. Consumer confidence is still quite low. Unemployment is picking up, and particularly youth unemployment, which is well over 20%. So let me finish by talking about the outlook. And I thought, before I give any forecasts, this quote from the Reserve Bank's Deputy Governor was a wonderful one, who said, "It's not important to predict perfectly, but to understand the range of possibilities and plan accordingly." So don't put too much faith in predictions from myself and then other economists, but certainly use them to plan. Look at upsides, downsides, what scenarios might be out there. I think it still gives you a useful planning tool. In terms of actual forecasts, these are the forecasts from the Reserve Bank for the Australian economy. And you might say, well, where are yours? Why use the Reserve Bank? And I've sat back and thought, well, they have quite literally hundreds of economists working. So I think they probably got as much, if not a lot more idea than I do in terms of where things are going. Where are we going? If you look at the gross domestic product at the top, overall economic growth, just go right across to the last number there, December 2027, 2%. Most recent quarter's growth, 2.1%. So they really don't see much pickup, and they see that sort of 2% growth number for Australia as being likely to where we're going to be stuck around for the next couple of years. Inflation, they do see improving a little bit, but still above 3% in the middle of next year before it starts to fall a bit more at the end of 2026. So again, that's why I don't see that there's necessarily going to be a rate hike unless they're wrong and I'm wrong, and this latest 3.8 inflation is a trend rather than some sort of one-off. If inflation sticks around that 3% or gets back into the band in the next 6 months or so, I think certainly we'll see things on hold, but there's more chance that towards the end of next year, maybe we might still see one more rate cut. Globally, major trading partner growth, I think probably covered this really many times, at the risk of being boring. It's going sideways at slower than historic levels, I think, is really the rough answer. These numbers, you'll see, they come from a variety of sources, but I think everyone pretty much agrees China might slow a little bit more, but we're looking at that 4%, 5% growth, not the 8 to 10% we used to see. US, not much better than it has been, and certainly well below long-term averages. And that's really, I think, the summary probably, that it's a modest growth for the world. We don't see ourselves getting into a lot of trouble, but not much of a pickup either. In terms of that quote I put from the Reserve Bank Deputy Governor, I thought this was interesting. When the US Federal Reserve put out their forecasts, the blue shaded area is their 70% confidence interval. So although the red line there is what they're forecasting, they're honest enough to suggest that they might be wrong, and they suggest what the upside and downside scenarios might be around that number. So I think that's interesting, and that gives you a guide to where we think things are going. So modest growth in Australia, hopefully a bit of a pickup from consumers and business to take over from the government spending we've been seeing. Not likely to see further rate cuts, maybe one out there, but certainly no rate hikes on the horizon, and generally modest growth for the rest of the world as well, which is likely to limit upside for the Aussie dollar. So I'll leave it there. I'll hand back to Stephanie, and more than happy to take questions. Thank you,
David. Thank you very much for that. And thanks for incorporating some of the insights from the Vistage Confidence Index. I think that really brought it closer to our community as well. So we do have a couple of questions. Please put your questions in the Q&A, and we'll get to as many as we can in the time. So the first one is, if the population isn't really growing and we have a pretty high standard of living, why is growth so important for economic health?
No, that's a very good question. I think from a business point of view, growth generally means more sales and hopefully more profits. A bigger economy gives you a bigger target market. So that all sounds well and good, but I think the important thing in terms of standard of living and so on, as I mentioned, is maybe for us individually is per capita growth. That's what we've not seen. So if the economy grows at 2 or 3% in the next few years, and I'm a retailer, I can sell more stuff, that's great. But if the number of people grows 2 or 3%, we're not getting better off. There's just more of us. So I think that's the key difference.
Yeah, great. Thank you. Thanks, David. Next one from Jack. How much trust do you place in CPI and inflation numbers? He said there seems to be more and more adjustments made by the ABS in recent years, most of which skew the inflation number lower.
I think I'd put a fair bit of trust in them. And I mean, we also have the GDP deflator, which comes out with the quarterly numbers, which has not been that different. I mean, the headline CPI obviously does jump around. You know, that 3.8% was driven by things like the government stopping the energy rebates that had been in place and things like that. The petrol price and goes up and down, that drives it. But underlying numbers, they've got a pretty good idea of what's going on. They adjust the basket now and then for things we buy or don't buy. I think I forget what was the latest one. There was some sort of technology type thing that they started to include more. 20 years ago, mobile phones wouldn't have been a big thing. Now they are, and so on. Cigarette prices, that's right. That was the one that hit the headlines lately. You've probably seen, apparently people who do smoke now buy them from illegal tobacconists.
Yeah.
And the ABS measures cigarette prices as small part of the CPI, but from Coles and Woolies of the world, and they don't sell much anymore. So they said they're actually going to try and track the black market. So they do keep an eye on what's going on in the world. I think the numbers are fairly reliable.
Thank you. So Amy's asked this about your opinion actually here, David. Do you believe the AI bubble is inflated? And how could this impact us with the top 10 tech companies being 40% of the S&P?
Oh, yeah, that's maybe a little bit out of my area. I don't want to be giving financial advice to to people on a webinar, but I think what struck me, if you'd asked me 12, 18 months ago, I would have said, oh my goodness, this is crazy. We should be shorting Nvidia and so on. But it seems to keep going and going. And every day we keep hearing more things that AI can do that we probably wouldn't have dreamed of 3, 4 years ago, let alone 10 years. So I don't know. Honestly, it's interesting. I mean, people suggest the rest of the world's stock markets are fairly valued. It's only these few big companies that have gone crazy. That might be the case, but they seem to keep every time they come out with their earnings numbers, they seem to deliver what people expected or more, and the prices keep going up. So yeah, I don't want to say whether it's a bubble or not, but there certainly seems to be just more and more uses for AI, and uh, that's certainly helping them at the moment anyway.
Okay, we can leave that one at that. Thank you. What about from Deran? Given levels of public and private debt and only modest growth, how do we avoid a significant recession? Aren't current levels unsustainable?
So levels of debt, we're talking about being unsustainable. Is that that's the
Not
question?
sure. Yeah.
I mean, I think how we're going to avoid a recession is really the Reserve Bank, despite what the Treasurer and others might tell us. It's probably the Reserve Bank that's has a lot more sway on the future of the economy than the government policies and budgets and the like. Um, they do keep, as I mentioned, a strong eye on inflation and unemployment. If they see job ads falling, unemployment getting to 5% rather than the 4.3 we're looking at now, we'd see rate cuts, and that would definitely help stabilise things. Government debt, like you said, in Australia, it's not going down, and they don't seem to want to cut spending. Saw recently that Victoria announced they were going to cut so many billions and billions from spending, but then announced new projects that were worth more than that. So there's definitely a reluctance from the politicians to do what might be needed to get debt levels down, but they're not dangerous. I don't think we're in trouble that way. And, the economy seems to be doing well. Most people have a job. Confidence could be higher. We could be doing a bit better, but it's not that bad.
Okay, thank you. I love an economic outlook. It's not that bad. It's great. Thank you. What a way to almost finish. One from Anthony, and I'm not sure if this is your area. Do you have an insight on the cost of energy going forward and the impact on productivity?
Oh, yeah, no, that's probably not something I'd claim to be an expert on. I suspect the cost of energy is going up, and whether you're a believer in alternative energy and solar and wind and so on are going to take over. There's huge capex involved. There's massive distribution infrastructure that has to go in place. We can build solar farms in the desert, but we've got to put the wires from there back to the big cities. That's going to cost a lot of money, and someone has to pay for it. If you think none of that makes sense, and like some state governments, we're going to subsidise coal to keep going longer, well, we have to pay for that as well. So unfortunately, I don't see any answers except that it's going to become more expensive, which is probably not a good outlook for businesses, particularly those that use a lot of energy like manufacturing.
Mm. So, a final question from me, David. How valuable for you are the insights from our Vistage members when you look at our confidence index each quarter?
Oh, they're really good. I think it's really useful because I know it's coming from real people running real businesses, if you like. And, we had the question about the CPI numbers, and I do think the people at the ABS are doing a good job, but nonetheless, it's nice to see what people on the ground, if you like, are feeling and planning as much as what the numbers from bureaucrats in Canberra might be suggesting is going on in the world. I think it's very useful, particularly now we've done it a few times and we're starting to get trends.
Yeah.
We can see if things are improving or slowing, or they're willing to spend more or not.
Great. And thank you to our members who participate, because that's one thing with, the consistency and the trends. David, that was really interesting. And it was just straightforward, moderated, considered. And thank you very much for your preparation and for your presentation today. And thank you to all, for our members, our chairs and our guests who have joined us today. Wonderful to have you with us. Wishing you from all of us at Vistage all the very best for the holiday season and for Christmas and the New Year. And look forward to seeing you for our summer series webinars that will kick off in January. And we look forward to advertising those for you all very soon. Thank you, David. And thank you all very much. Have a great rest of day.
Thank you. Bye-bye.